Company origin is pivotal to shaping our framework for investing. We started the firm 16 years ago. We started in 2008. We went through the great financial crisis.
And so we had the fortune, in retrospect, of watching the real estate market fall apart, the wheels come off of the train. What that helped us learn is how to manage through difficulty and distress.
I think what we saw during the GFC was a lot of distress, mostly regarding over leverage of assets and buying at a high price point above the basis of the building. So I think some of the main lessons that we've learned is conservative debt. We typically are 60 to 65% loan to value at the high end. Always fixed rate debt at a minimum of 5-year term. Those two things alone have helped allow us to not be overburdened and not have an asset that's performing well be pressured by the debt that's on the property.
Every decision that we make is based on our best knowledge with a tie back to history to make sure that we don't duplicate any of the mistakes that were made by all those people in 2008 and through the GFC. To ensure that our investors are protected, we take extensive measures to mitigate risk. We check and double check. We invest in areas and in economies where we believe there's not only sustainable opportunity, but the opportunity for failure is mitigated by, multi-tenant, by well located. We buy things right on the way in. We always make sure there's a big mark to market. There's a lot of different insulators to keep us away from those bad times we'll remember so well.
Companies founded during the great financial crisis are much more risk averse, much more sensitive to positive cash flows, much more cost efficient. So when we go into investing, we try to budget for the unknowns, the what if the plan isn't completed in the certain amount of time. So we try to leave a contingency so that we're able to go in and still make the plan. So we leave a little room.
Our history makes us well prepared for the future because we've been through ups and downs. We've invested in at least 50 properties since then, and we've managed hundreds. We've bought and sold hundreds in the early years on behalf of clients. But we've seen most of the things that can happen in real estate, and this develops an intuition and a resilience and a firm history that allows you to overcome sort of whatever can pop up.
So as we go forward, keeping in mind what we've learned in the past, we hire very competent people. We love to use the phrase around here that we have exceptional colleagues, and we do. When we staff out positions in the company, we're allowing people to work in their areas of highest competency. That always leads to, if you've hired the right person, really good continuity, a high level of trust. That's critical in times like this.
The lessons that we've learned through these market cycles have really prepared us to not only weather the future, but to really take advantage of the future as well. The way that we go about investing needs a level of conservatism to be able to contemplate these downturns. The real estate market is a cycle. And so while right now we happen to be in a very fruitful time of the real estate cycle at the bottom of the market, we also recognize that these cycles come back again, and using the conservatism that we've learned through our history has helped us be better suited for the future too.
Thank you. Thank you. Good morning. This morning I wanted to spend a little bit of time borrowing from Simon Sinek and talking about the why. But I'm not going to talk about the why of why our company exists or the purpose of our company, but rather I wanted to talk about the why of why we invest in secondary and tertiary markets, like the banners here say. And to do that, I need to give a little bit of history or background on our company. And not this background, but I thought this photo would be good because this is a few months after Joe and I first started becoming friends in third grade. That is actually Joe and Ryan there. Notice Joe has the slingshot. But I wanted to talk about this history. We started the firm in December of 2008, just a few months after the collapse of Lehman Brothers. And we knew that we were entering an economic downturn. The market had already softened, but we didn't, and I don't think most people in the room recognized that they were entering the deepest economic recession we've seen in a decade, in any of our lifetimes, really. And we started a brokerage and a property management company. And during the first 5 years, we used to joke that we never knew what a good year looked like, because this is what it looked like. You can see there that 2008 was a 37% decline in property values subsequent to that. And we started the company right at the beginning of that gray bar. So it was a great time to learn. We spent a lot of time with REOs, bank-owned properties. We worked with special servicers. We worked with special assets. We worked with distressed borrowers. Sometimes we were the ones walking into a place of business and notifying that business owner that they no longer owned the property that their business was in. Other times we were taking over properties that had not been maintained or occupied for months, sometimes longer. We were working with distressed tenants that were trying to keep their business open during this very problematic time. And banks and lenders gave us a lot of their worst assets to work through. And so with that, we were able to learn how to create and maintain value during this incredibly traumatic time in the real estate market. And there were some lessons that we learned along the way. One of the lessons is bad debt can make good investors make bad decisions. And so we focus a lot on conservative leverage. Our portfolio-wide leverage today is 54%. And that's after the recent last couple of years of market declines that we've seen. We also learned that you make your money on the purchase, not on the sale. You make your money going in. And so we've always focused on buying well, because we saw some of the challenges during the GFC is people buying properties at this kind of peak frenzied pricing and then trying to navigate through the downturn after that. We also learned that adding value not only improves the upside, but it also mitigates the downside. And so we focus very much on getting in and adding value quickly. That's kind of a mantra, add value quickly, because that not only helps on the upside, but again, it helps create a floor for the downside scenario. We also, during that time, as I mentioned, had a brokerage business. That's Joe's name on the sign. I had my name on signs, and we had other agents as well. And being in the brokerage business taught us a lot as well, because we learned how to develop those deep, durable relationships in the brokerage community. And we learned how to foster relationships with owners of properties in these markets that are smaller and harder to enter. In smaller markets, it makes sense that, they tend to be a little more insular, relationships are a little bit tighter. We learned how to do that. And Joe often says we speak broker. When we speak to brokers, they understand there's a pureness to our relationship because we were in the same shoes. And we understand seller psychology better because a lot of times we were the advisor to the seller. And borrowing another phrase that Joe uses, we knew how to help sellers through their stages of grief. This is the process of a seller recognizing that the value they thought their property was worth, it's not worth. And it's an iterative process. And by being in the brokerage business, we really started to understand that seller psychology. We also started investing during that period of time over a decade ago, and we took those lessons that we've learned into our investing. But another thing happened during that time. As we started investing, we started to realize that in our markets, they perform differently than like the San Francisco Bay or the LA area. And we found that we had an easier time achieving return than our peers in those primary markets. And this was not only during the upcycle that we saw prior to 2022, but even during the declines, we've been able to maintain top quartile performance. And we started to ask ourselves, okay, how are secondary and tertiary markets different than primary markets? Why is it that we're able to do the same investment at a same level of risk and achieve a better return as a result of that? And really, it's a tale of two cities. And I'll speak a little bit about this, but as I go through this, I think a lot of this will be intuitive to you. But in primary markets, you have more sophisticated competition, the Blackstones, the Brookfields of the world. In secondary and tertiary markets, you have less sophisticated competition, which makes it easier to gain alpha in these markets. In primary markets, you have more presence of institutional capital, particularly at that larger asset size where institutions invest. And of course, institutional capital is hyper efficient, it's very sophisticated, it's very competitive. Meanwhile, in secondary and tertiary markets, it's majority private capital. And private capital tends to be less efficient. Private capital also has different objectives or motivations than institutional capital. So when we as an institutional manager are working in secondary and tertiary markets, that we have different, candidly, a lot of the times the sellers that we're buying from, they just have different motivations and objectives than we do. We're not buying from institutions who have those same objectives that we do. And primary markets are more efficient. There's better data availability, third-party reports. Anything that you want to know about that market is more readily available. The purchase process is more efficient. So typically, when a property is sold in a primary market, it's this hyper-bidded process. A lot of capital is chasing the best deals, and you become the successful investor by bidding the highest price for the property. Also, execution is more efficient in these markets. So there's better vendor availability, there's better service providers, and so the ability to execute is easier in these markets. Secondary and tertiary markets, less data availability. We find that a lot of the proprietary data that we get from our properties and our experience is the best data available in those markets. We also find that the purchase process is a lot less efficient. We're able to buy off market in kind of a non-bidded manner. And execution is less efficient. That's why we're vertically integrated and we control the aspects of execution in the markets, because it's harder to rely on third-party service providers to do that. So when you really zoom back, and this is kind of a little bit of the aha for us, but when you really zoom back, when you have an efficient market, by definition, to achieve the same risk, to achieve the same return, you have to take higher risk. To achieve that same return in an inefficient market, you don't have to take as much risk. And I'd say that was really the aha for us. And we started to realize, okay, that's true in the markets where we're currently investing, Modesto, Sacramento, Fresno. And we started to realize through testing and through continuing to invest in other markets that this is true in secondary and tertiary markets throughout the Western U.S. And so the next thing we ask ourselves is, well, what is the market opportunity? What is the size? And you can see from some of the data points here, it's a substantial market. It's 85 markets, $1.6 trillion just in multifamily and industrial real estate. And for context, that's 4 times the size of the whole U.S. self-storage market. So we realized these markets perform differently, and we realized that the market opportunity is large. And so you have to ask yourself, if you could start a business and you knew that the market opportunity was large and you knew that you had limited or no competition, would you start that business? Probably. And so we had to ask ourselves, if not us, then who? And that's really what led us down this path. And we realized that we're uniquely well suited to be able to execute on this opportunity. We have some unique competitive advantages that have allowed us to be successful. Sourcing. because of our brokerage background, we understood sourcing of deals, finding opportunities better than someone who didn't come from that brokerage background. We're used to working with dysfunctional sellers. A lot of times, the greatest value that we're creating is actually buying from a dysfunctional seller. The asset has not been maintained, it has not been invested in. Execution. It's because of our property and asset management background that we are able to execute swiftly on the properties. We understand, for us, property management is not an annoying part of the business that we have to deal with. It is an integral part of who we are and what we do. Same with asset management. Experience. So we didn't start in Los Angeles saying, hey, I think I'm going to start investing in these smaller markets. We're based in Modesto. A lot of times for some of the investors that we talk to, that's a talking point. Okay, tell me more. You're based in Modesto? Why? And that's really critical to who we are and our story and how we understand and relate to these markets. And then the last thing that I would mention is resilience. And we've touched on this a little bit, but for us, conservative purchase price, conservative debt, and the ability to add value quickly is really critical. It's a critical approach, and it comes from that resilience that we learned through going through the downturn. So all of that is to say that is the story of why we that is the story of why we invested in secondary and tertiary, or why we started investing in secondary and tertiary markets. And I like to say that the journey is the story. The journey is the reason why we do what we do today. So thank you.